Hey everyone, Couch Investor back to another video for today. So, if you missed the Amazon earnings report video, that will be in the top right corner. In this video, we're going to focus on Google Alphabet. They actually missed on earnings per share and on revenue as well. Now today, the stock market started a bit weak. Now we're a bit more strong-ish. Payroll numbers, non-farm payroll numbers came in much stronger than expected. Unemployment is actually now at 3.4%, previously 3.5%, expected was 3.6%. So still the job market very, very strong. We'll see what that means when it comes to the Fed meeting 1 month from now. Now, with Alphabet, Google, we already knew what was going to happen, right? We already talked about cloud when it comes to Amazon, when it comes to Microsoft. We had Meta, we had Snap, although Snap, let's disregard that. We have Meta when it comes to advertising. And if we don't want to mention other companies, we already knew what happened last quarter with Alphabet, right? Weakening in the advertising market across the board, not just from them. Then the YouTube side has been a bit weaker than expected. Let's see what happened in this quarter. Now the full focus obviously is going to be on the cloud. We talked about Azure, we talked about AWS, two of the biggest players there. Number 3 is Google. Now, of course, we know it's still unprofitable, but is it getting better or is it getting worse? We're going to go all over that in this video. Of course, we already have some new price targets from analysts, lowerings, and actually more raises than I expected. Those are going to pop up on the screen here. So if you want to look at them, just pause the video. Then at the end, we're going to have a look at the graph real quick and conclude the video. So if you're interested in all of that, maybe hit that thumbs up button, subscribe if you have not, would really, really appreciate that. We're trying to reach 30,000 subscribers by the end of the year. Let's see if that's feasible. And if you want to support me even further, you can check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. So first things first here, we're going to talk about this little comment here by the CEO, Sundar Pichai. So our long-term investment in deep computer science make us extremely well positioned as AI reaches an inflection point. Of course, AI is the talk of the town now since ChatGPT came out late last year. And I'm excited by the AI-driven leaps we're about to unveil in search and beyond. There's also great momentum in cloud, YouTube subscription, and our Pixel devices. We're on an important journey to re-engineer our cost structure in a durable way and to build financially sustainable, vibrant, growing businesses across Alphabet. Especially this part right here, re-engineering the cost structure has been a struggle lately. Of course, with the recent announcement of these layoffs, the market seems to be a bit more positive when it comes to Alphabet. Now, with regards to the CFO's comment, we're going to have a look at the actual numbers, which makes this much, much simpler. So on the left here, we have the numbers for this quarter, on the right for the full year. So for this quarter, well, the change is not that wow. Let's say it's 1% growth year over year or 7% on a FX neutral basis. Now, when it comes to operating income, lower than last year, and operating income margin is lower as well, also lower than last quarter. Last quarter, it was 25% operating margin, and that's although operating income coming a bit higher than last quarter. Now, with regards to net income, we're at $13.6 billion and diluted earnings per share of just $1.05. Now, of course, as for the full year, you can see the year-over-year comparisons here as well. Revenue is higher this year, so overall, they're growing still double digits, although just 10%. But if you look at operating income, operating margin, net income, and diluted earnings per share, that's a bit less year over year. And granted, we are in a more difficult macroeconomic environment, especially when it comes to advertising, because, shall I remind you, the majority of Alphabet's business still comes from that segment, Google advertising. It's down year over year from $61.2 billion to $59 billion. But I do have some better news to share here. So all these segments here, Google Search, YouTube Ads, and Google Network are all up quarter over quarter. Of course, they're down year over year, but especially YouTube Ads is now at $7.96 billion. That's down quite a lot since last year, but since last quarter was just over $7 billion. So nice little quarter there. Then when it comes to, in my opinion, the most important metric, if you want to look at growth for Google, is obviously Google Cloud. We're now at $7.31 billion, big increase year over year. And then to compare it to last quarter, we had $6.86 billion. So very nice to see that even quarter over quarter, they're growing that segment quite nicely. And now when it comes to number of employees, I'm still baffled by this. So of course, there's a huge increase year over year, but even still quarter over quarter, we're now at 190,234. Last quarter, we were at around 186,000. So they still added around 4,000 quarter over quarter. But of course, with the recent layoffs, as we can see here right now, in January 2023, we announced a reduction of our workforce of approximately 12,000 roles. We expect to incur employee severance and related charges of $1.9 billion to $2.3 billion, the majority of which will be reorganized in the first quarter of 2023. In addition, we're taking actions to optimize our global office space. As a result, we expect to incur exit costs relating to office space reductions of approximately $0.5 billion in the first quarter of 2023. We may incur additional charges in the future as we further evaluate our real estate needs. So of course, these are charges that will impact the company in the short term, should benefit it in the long term. Now going back here, scrolling up to the operating income segments. So Google services, of course, it's down year over year, but I like to focus on this right here, the Google Cloud one. It's still unprofitable, but again, good news here, quarter over quarter, this has improved. We're now negative 480 million. Before we had a loss of 1.61 billion. So of course, it's nice to see that at least Google Cloud, which again is that shiny piece of the business, is getting better and better. Although we've had, let's say, I wouldn't say worse, but not as good of those numbers with AWS and Azure in this weakish market. It's nice to see that Google Cloud is getting better and better. Now, of course, with the business itself slowing down as a whole, we have to look at free cash flow because you do still want to see how much cash this company generates, how much cash flows into the business that can be used for share repurchasing, or maybe in the future, who knows, well, don't say it's going to happen in the year or two to come, but maybe in a decade or so to be used as dividend payouts. It's just a long-term view. I don't think this is going to happen anytime soon, but we can see here free cash flow of $16 billion. Net cash provided by operating activities, $23.6 billion. I believe these numbers are flat quarter over quarter. So still in a difficult environment, this is a company that has a free cash flow of $16 billion. So quite nice if you ask me. Of course, when the market turns, especially the advertising market, the macroeconomic environment will change whenever that will happen. This will boost the business even more. So if right now in a difficult market, they can put up these type of numbers, $16 billion in free cash flow, the business itself is growing, of course, just 10% compared to before. But again, this was pushed forward by the growth in the pandemic. But if you want to focus, let's say, on just YouTube or the cloud, these businesses will be pushed forward in a huge, huge way when the economic environment worldwide becomes just much better. And especially with YouTube, I think they still have some tricks up their sleeves. Of course, we talked about the sports agreement there. I think it can be huge, especially when it comes to advertising, especially as the streaming market becomes bigger and bigger. So overall, in my opinion, this is just another case of if you can find any weakness in the stock, you can start accumulating more, because this is a company that is not going anywhere. This is still a company that generates $16 billion in free cash flow in this current environment. So if you're one of those Alphabet holders, well, in my opinion, I think you're more than happy to pick up more shares if you see any weakness in the stock. But of course, do share your thoughts down in the comments below. And then when it comes to the graph, obviously we've had a huge, huge green candle this week, as with most companies, because of, well, the Fed meeting, the earnings report, and just a general bullish market to start 2023. But the most important part here is what I highlighted it, the big green candle above that 200-day moving average. As you can see, in the past year, in August 2022, we tried, but failed miserably. And then we went to the lows here, $86. Right now, a big green candle above that 200-day moving average. We're still not oversold, still pretty far from there. MACD is still bullish, but we're still under the zero here. Of course, now it's Friday. Let's see if next week we can have another big green candle. Not as big, but a candle that would make us more comfortable above the 200-day moving average. If it's another red one and we go underneath, well, then the pattern again here is a bit broken. So that will be it for this video. Of course, I don't own Alphabet in my major portfolio. It's in the second one. smaller one just for companies where I just add $100 each month on the same day to those companies and see what happens. But I'm sure some of my viewers do have Alphabet at least in their top 3, maybe even top 2 holdings. So do share your thoughts down in the comments below. And if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.